Hey guys, super happy to be here once again. But today, where I have like one of the guests that I was waiting for having in the podcast for a very long time. Paul, it's a pleasure to have you here. But before you start, I would like to give like a short introduction, which is a thing that I don't necessarily do each and every single time. But with you, it's very demanding to do with. I have your portfolio open up in front of my eyes, as I told you previously, and I will read out the first sentence, and I think that that would be a great kickoff for our conversation. So, high frequency trading and underlying computational techniques, real time machine learning, time series databases, vector database, high performance computation, low latency, and high throughout computing involving novel devices such as GPUs, FPGA, IPU, TPU, etc. Applications of machine learning, AI to quantitative finance, applications to of machine learning, AI to econometrics, applications of ML AI to risk management, real time risks, application of machine learning, AI to drug discovery, graph neural networks, reinforcement learning, quantum computing, big data, open data, the philosophy and the ethics of machine learning and AI, which I would like to start out the conversation by understanding um, like everything that you have just mentioned with like the ideas or the rationale of like or your portfolio and like your perspective of being a researcher is that everything actually compounds uh, in a very significant manner to quantitative applications. Is that correct?
Yeah, I would say so. Yeah.
So that's a great idea, and I think that we're going to be having a very detailed conversation. But before we're going to be starting the conversation itself, I would like to thank you, and I would like to say that I'm very excited and very happy to have you here. And how are you today? We have just kicked out with you know very strong headline, but yeah.
Well, it's unusual. It's actually sunny in London today. I mean, it doesn't tend to happen very often. Maybe like once every couple of years, we have a sunny
Oh, it's a
day.
lucky day. It's a lucky day.
Yes. Yes.
Yeah, okay, mate. That's great. And yeah, just before we start, I would love if you can tell the audience a little bit about yourself. I guess that majority of the audience actually knows you from LinkedIn, but just to align everybody, yeah, I'm very happy to hear more about yourself.
Yes. So I've had effectively several um, current careers. I would say my main career has been a fairly standard career in quantitative finance. I joined Morgan Stanley after several internships. I joined them full time in 2005. And then I continued to work at primarily at large banks initially since 2005. I moved to Lehman Brothers, where I stayed until Lehman Brothers collapsed, unfortunately. Then Citigroup, then Nomura, then Deutsche Bank, BNP Paribas. And for around 2016, I started consulting, and I was consulting many organizations. Then from time to time, I was joining them full time as well. I spent more time after that on the buy side, working with electronic trading companies, high frequency trading companies, um, including QSpark in Israel. And for the past maybe 6 or so years, my focus was primarily on trading commodities, and I was working at futures and commodities trading companies, um, such as ENBW. That's the main kind of track on my career. At the same time, I was pursuing an academic career, so I started my PhD part-time in 2005 when I graduated from Imperial College. Then I did another degree at Oxford, and I started teaching in 2016 as well. And I continue to teach to this day. I continue to teach at the MSc Mathematics and Finance at Imperial College. Um, I also spent 2 years as a lecturer in mathematics for artificial intelligence in the Department of Computing. But I also teach organizations. So people approach Telesians Limited as a kind of as a training provider, as a graduate training provider or upskilling provider for various organizations. So the third track, so I would say, so there is the quant track, there is an academic track, and there is a third track which is entrepreneurship track, which is Telesians Limited, which I co-founded in 2009, and we write software. We basically provide software for banks, for hedge funds, for different types of organizations, and we develop algorithms and we develop training courses. That's what we do.
You know, that's very fascinating, and I do see correlation in your in the both careers you have chosen. So in 2016 was a very busy year because you started teaching, but you have started to do some consulting, which there is a very certain similarity in between the two. And I would like to ask you, out of your perspective, how would you think like um, the educational aspect of quantitative finance is back then and right now, and into a very slight comparison to the consultancy aspect of you basically, and how do you see the differentiation in between the two?
So
How do you see like the impact, the implementation, like the rapid, like the explorational patience, or the exploitational ambiguities, or and so on and so forth.
I would say that when I'm consulting and I'm working mostly with senior people, perhaps the pedagogical kind of aspect of things, so the digital aspect of things, is less emphasized when I'm talking to more junior audiences. With more junior audience, it's about how do we position the subject in such a way that it's accessible and that it compounds in the mind of the student, and also student to eventually work independently in this area. I think mathematical education in general suffers from this um, problem where you can, for example, you can teach specific algorithms or you teach specific techniques, and the person may say, okay, well, mathematics is really about these algorithms or techniques and so on, but the person is not necessarily enabled to work independently as a mathematician. So the skill set that's required for reading and actually doing math is quite different. You can prepare a lot of people who read maths at school, for example, but it's very difficult to kind of to nurture this creative aspect. And that's what I try to do as an educator. I try to say, well, look, I mean, here are some ideas. Now, can you synthesize them? Can you solve these exercises? Can you now step up the level of complexity and so on? So it's really more of an initiatory experience, really, with students, and that is irrespective of whether the students are um, undergraduate or graduate, or perhaps they're already working somewhere. It's this initiatory aspect that is the challenge.
Yeah, you know, it's very intriguing because you work with very junior levels like at university, and you work simultaneously with very senior levels in the industry. And when you tackle your students with I don't know with a mathematical problem, trying to resolve something, I think that there is a certain when you actually initiate the problem, and when you actually approach and tackle it, for you as a professor guiding your students, you actually force to do have a research and to find out some areas that you haven't been really touch with like in comparison to consult big and very large firms. Or like how do you actually teach them? How do you actually lay them towards understanding the market and understanding the right way to do research?
Yeah. So I think if we separate the content uh, from it, the practice of research follows a certain pattern, right? So you can um, you can, to some extent, the practice of research from the content. And it's a set of techniques, right? How do you, for example, read unfamiliar material quickly? How do you decide whether a particular piece of research is reliable? How do you quickly replicate it and come up with conclusions as to um, its correctness? And how do you then ask the right questions, which lead to further discoveries? How do it? So a lot of this process is
No,
independent.
that critical thinking process, nowadays I think compounds the most because you have like all the technologies that you have like literally in your hands, and that aspect of critical thinking, and I speak to a lot of quants here on air and off air, to be frank, about how do they leverage their critical thinking skills nowadays, with like all the capabilities and the new capabilities offered by various LLMs or AI models and so on. And I would like to ask you, how do you force them to tackle or to leverage their thinking capabilities and actually leverage it into much more inherent thinking ability to think critically about their research?
Um, so I try to teach the process, and there is a literature process. Um, there are multiple strands of literature. There is literature on lateral, for example, sort of De Bono's style and so on. There is literature on mathematical Olympiads, right? Although I wouldn't necessarily say that kind of mathematical Olympiad style of solving problems is always what people do in research. It tends to be much slower, the research process. This specific set of techniques that people encounter in mathematical Olympiads does help. There have been various attempts to formalize the process of scientific creativity. Uh, for example, um, for example, Genrich Altschul in the Soviet Union was working on something called TRIZ, and TRIZ is actually popular in Israel nowadays. It's an attempt to fix the creative processes, TRIZ. So looking at what people have done in these areas, but also I look at the original research by successful scientists, say over history. So maybe looking at, say, Newton's bio and how Newton structured his work and how he structured his experiments. With quantitative finance in particular, what I find helpful is looking at the history of quantitative finance, understanding what were developed when, what circumstances led to the development of those ideas. Even if we look at, for example, classical stuff such as Black-Scholes-Merton framework, what were circumstances, economical circumstances, political circumstances, what was the climate that led to the development of those ideas? So, and then I try to understand, I try to sort of reverse engineer the process for obtaining these ideas.
Just to understand those pinpoints who led like the innovative or the innovation of the idea, just to understand like the roots of what actually happens underneath in order to understand like or to prod your imagination and understanding of the problem itself that you're actually tackling.
Yes. So, I mean, let's take, for example, let's take Newton's work, right? A lot of his early work
A
was,
lot of work he was doing over the years. A lot of
yes,
work.
a,
Was
a
very
lot of,
busy.
exactly, a lot of the work was methodological. Initially, he was working on calculus before he started to apply these ideas to mechanics and so on. So he was working on his tooling, if you like. He was working on his intellectual tooling, and he developed it, and then he started to get results as a consequence of that tooling. And when you look at it, you say, okay, why did he develop this specific tooling? Why did he develop it in this order? How did he manage to do it? What kind of environment did he need? We know that Newton needed isolation for a while. So he worked alone in Cambridge. He avoided a lot of contact with other researchers. And research is a social process, but sometimes it's a good idea to say, look, there's so much going on, right? There are a lot of different strands of research, but I'm going to focus on this, and I'm not going to let external information distract me from this specific direction. So research oscillates from this kind of inward looking phase to perhaps, kind of collaboration and validation phase, to talk to others. So that is also an important aspect of it.
You know, there is a very like in our previous call, in our introductory call, we have spoken a lot about reinforcement learning, and nowadays there is a very very like a very large noise in the industry talking about the limitations of large language models, and basically their capabilities have been reached to max, and we speak right now about post-training with reinforcement learning, and it's very excites me because the initiation of that idea starts from the bitter lesson. If you're familiar with our research, I'm sure you are, and it's very fascinates me because you know it forces people to think about each and every single token or each and every single problem in a very separate manner, and during reinforcement learning to understand the underlying cause of that problem. Now, I would like to ask you, because you have spoken about mathematics and AI and like computational AI and computational finance, which tends to be that there is very much a line in between the topics, and right now we see a significant trend that people understand the capabilities of large language models. They need much more energy and they need much more computational force, and we cannot do like the entire world like build infrastructure of data centers, which literally impossible. This is a very large bottleneck for scale. And I would like to ask you, and to have like a much more of a critical thinking process with you here, understanding the capabilities and the bottlenecks of large language models, and right now the industry shift to reinforcement learning doing post training. I would like to ask you, what do you think about that phenomenon during reinforcement learning, and how do you, as a quantitative as a quantitative professor in in Oxford, how would you will take your students to think critically on how the industry shifts, because the industry will shift if the large language models will be built differently. So how do you actually align those industry shifts to understanding how to do proper research with the continuation of the research and deployment world behind it?
Yes, so when you talk about um, reinforcement learning is closely related to optimal control or optimal stochastic control. And it was Merton who introduced a lot of the aspects of optimal stochastic control into finance, back when he was working with Black and Scholes. And that introduction has influenced to a large extent later work, such as, for example, the Almgren and Chris framework. But reinforcement learning is very closely related to optimal stochastic control. So finance has been using it for some time. It wasn't focusing on the same algorithmic aspects and computational aspects that the reinforcement learning community was focusing in computer science, but the heritage, if you like, of optimal stochastic control, of various variants of the Bellman equation, for example, the HJB equation, and so on. They have been in finance for a long time. So Merton, back in the 1970s, 1980s, succeeded in bringing this apparatus into finance, and he did a lot of the work required to popularize it. So if you think about the steps that take it from stochastic control to reinforcement learning, they would be simpler than the steps that were already taken by Merton, and they would be kind of natural extensions of those steps. And people who have succeeded in popularizing reinforcement learning, Igor Halperin, Matthew Dixon, um, a few others, perhaps the late John Hull, um, who passed away recently, they have done a lot of work on bridging that gap between the already present optimal stochastic control and reinforcement learning. Um, there are challenges involved in productionization of reinforcement learning because it brings these meta parameters, uh, the learning rate, um, epsilon, and so on, into the quantitative finance desk, where people will argue, okay, well, I was already, dealing with the parameters of the model, which have financial meaning, whereas now I have all these meta parameters about learning. How do I deal with that? So that's one of the challenges in finance that prevents adoption of a lot of these models, where people say, okay, well, I need to really understand, what the parameters are and so on, and I don't want to keep the parameters. I want to keep the parameter set small. That's one of the problems. The second problem is the engineering aspect. So perhaps 10 years ago, right, reinforcement learning was still relatively new. There were a lot of questions about the stability of the algorithms, properties when they run, and how do they converge and so on. Now there are a lot of results on these properties, so there is less of a reason to delay the adoption of these algorithms in the financial context. But some areas, such as, for example, high frequency trading, right? They will perhaps be looking at different approximations because of the performance requirements. You mentioned those requirements for AI in general. You mentioned the limitations on the number of the number of flops, on the on the heat produced by these calculations. Now we know that a lot of current calculations are energy inefficient simply because they haven't really been optimized from the energy perspective. So one of the papers that I have um, on um, on LinkedIn is my work with Sabakinskih, where we implemented elements of LLMs on FPGAs. So we did that a few years ago. So we them to FPGAs, and FPGAs are already much more efficient than classical architectures, and they're more energy efficient. And if you move further to ASICs, for example, you can further bring down the energy footprint. And we already see that a lot of the work in on the side of things is focusing on creating custom architectures that can work efficiently with AI algorithms, and that work is already underway. So I think what we're seeing now is a heavily suboptimal use of CPUs and GPUs, which can be improved by taking into account the geometry of these calculations, and the energy footprint can be brought down considerably, and that there is ongoing work on that. So that's from the energy efficiency point of view. Um, I'm not necessarily saying that some of these architectures, people just look at them from the point of view of performance, but if you look at things like ASICs and ASIC-like constructions, um, then it is certainly possible to make them to make these calculations more efficient. And there's some information on how to do that even in my own work. But things like DeepSeek, for example, they also look at the algorithmics of it. So kind of how can we make things more efficient algorithmically, and that is also going on.
Yeah, and there's still a rush of nowadays by DeepSeek with the MOE. If and previously, right now, NVIDIA just released the GDPO, if I remember the term, which is like an extension or an enhanced or an enhancement of GRPO. But it's very fascinating how people actually approach and give the right attribution to algorithmics uh, themselves, and how to improve them computationally and do it like in a much more concrete and comprehensive manner, just to enforce and to make those algorithms much more faster and efficient. Now, I would like to dive deep into reinforcement learning, which is a thing that I think really fascinates because especially everybody nowadays, because of the phenomenon we have spoken about previously. But reinforcement learning in finance and in trading and high frequency, it's a different problem. And I would like, because agent interacts with an environment, and the environment is a chaotic market, which is uncontrollable, and like like as broader your exposure is, like the impossible problem it gets to be. And I would like to ask you, Paul, how do you tackle reinforcement learning, and how do you use reinforcement learning, if you use reinforcement learning, from your ideas like in academia, and how do you, if implementation ever happened, I would like if you can just talk to us about how you have done it.
Yeah. So in many ways, financial reinforcement learning is easier than cloud reinforcement learning that we see in robotics. And I'll
Cloud
qualify
or classical? I could really catch the term cloud reinforcement learning or
uh,
classical reinforcement learning.
classical reinforcement learning.
Classical reinforcement learning. Okay.
And the reason for that is that you are in a situation where you are interacting with the market and affecting the market through, for example, market impact. And there are those situations, right? But in many cases, for example, say your strategy operates with relatively small sizes, right? So it's not really moving the market as much. Then market impact in those situations is less relevant, and you are not really moving the market that much, right? So the reaction of the market to your actions becomes irrelevant, right? If you are not in the kind of market impact space. And so you have the advantage that you can actually assess the value of a large number of actions, whether you take them or not. And this is a strictly easier problem than what you encounter, for example, in the setting of multi-armed bandits in reinforcement learning. So you can say, look, I mean, there are these 10 possible actions that I could take, but I don't necessarily need to take them to evaluate them, right? I
With
can just
with the bandit algorithm.
no, with financial reinforcement learning. With the
Okay.
bandit algorithm, you do need to take the action to evaluate it, and you cannot evaluate the simultaneously the actions that you didn't take. Whereas in
Okay.
finance, you can do an update through your action state space. You can sweep through it quite easily through the entire space. So you have a much easier problem than your classical Bellman equation, where you say, "Look, I'm going to take that action. That's the only action I can assess, and that's really where I can update this state action space."
So you actually referring this, sorry to interrupt, just to clarify, what we're speaking about right here is that you're referring like the Bellman equation, or
Yes.
like the initiation of the famous Q algorithm, like to hypothetically set up, you know, large amount of hypothetical occasions, and you
Yeah.
actually interact each and every single time towards all the hypothetical situations or simulations that you're actually activating, just to understand what happened if the market was in that stage, and what will happen if like conversely if the market was in that stage, et cetera, et cetera, et cetera, which like enriches your understanding of like the capabilities or the environment. Like what's the final idea?
Yeah. Well, look at this object that we're updating, this array, right? Across the algorithms, across SARS, RNQ learning, and so on. So one dimension of this array is the actions that you take, and another is the states of the system. Now, the difficulty with the market is that you cannot always simulate those states. It's not a black box physical system where you can say, look, if it were in this state, how would it behave, right? You cannot sort of take it apart and say, look, let's imagine it's in this state, right? Um, so that's slightly harder than some of the physical systems, say in robotics, where you can put the system in the state that you are interested in by just say by moving the robot somewhere else, right? So or moving the self-driving car somewhere else and setting its velocity to a certain number. In finance, it's harder to do that. You have to rely on, say, historical observations of the market. But with actions, right? So unless you're taking into account the market impact in your physical system, you take an action, and sometimes you don't know in advance how the physical system is going to react to that, but you are limited to the feedback on that specific action. In finance, you can say, look, I mean, if I go long, here is the feedback that the market gives me. However, I can also compute by now the feedback that I would get if I went short. Right, straightforward calculation. I don't need to have done it, but I can see inside what it would have cost me if I went short, right? And you can do for different sizes as well. You can say, look, if I went long 1 unit, I would get this. If I went long 2 units, I would get this. And these are the calculations you can perform once you have observed the next state of the market, right? So you can compute a lot of this space, even if you didn't go long. If say you went short, right, you can still compute the update for going long, right? So and again, unless you're in a situation where there is kind of difficult to model market impact, and you want to model that market impact empirically, you are in a much more convenient situation where you can update a lot of the actions hypothetically, right? And you can do all sorts of various nice things. You can parallelize this update. You can do some sort of importance sampling or other similar techniques in your search space. You can do a lot of mathematical tricks that may not be possible in other environments. So in effect, finance is not always a harder problem because of the non-stationarity and so on. But by the way, non-stationarity is a common concern in reinforcement learning, and people do study non-stationarity in a lot of detail within reinforcement learning. And a lot of the ideas for dealing with non-station environments were developed in reinforcement learning. For example, in say when you play Atari games and so on, so various tricks with the replay buffers and so on, they entered finance from reinforcement learning.
That's a very clever idea, to be frank with you, to compute to compute empirically what will happen if I will do this, or what will happen if I'll go long, or if I'll go short, or if I'll do like various types of decisions. But for you, in the end, like understanding that that's the necessary step to do onward to compute different variations, and to understand if what will happen if you go long or short, or different variations. How would you actually derive a decision out of that process? How would you actually take all the computation that you have just done? Okay, now you understand the data. How would you leverage that database that you have created, or the buffer, or the whatever you want to call it, and how do you actually leverage it into a decision that actually can compound into money making machine?
Yes, so that's where reinforcement learning as a discipline offers you a solution. The
As a
way
discipline,
as a discipline.
that's interesting. Okay.
Uh, the approach taken in reinforcement learning is to apply Bellman's reasoning, um, a divide and conquer approach to the problem, and separate um the uh, individuals within the Bellman equation. So all these algorithms, such as SARS and Q learning, they are built on a particular variant of the Bellman equation. And that is largely what reinforcement learning is about. It gives you these algorithms, and it gives you various numerical approximations around these algorithms, such as, for example, temporal differences. So that is already an answer to this question. How do you update on the basis of this partial knowledge of your state action space? That's precisely what reinforcement learning contributes. It could be a SARS update, it could be a Q-learning update, but we take into account those things that we discussed previously, which is, can we somehow enhance these updates? Can we update optimally for the specific problem that we are solving? For example, can I update a larger section of the state action space than just for the action that I've taken? Right. So that's one of the optimizations that we can perform fairly easily. Right. But I mean, a lot of the thinking then, after taking these ideas on board from the classical reinforcement learning, is how can I take the specifics of the problem that I'm solving into account in this situation? And this is where engineering begins. Because if you look at a lot of the progress in reinforcement learning or its successful applications, for example, to the game of Go, AlphaGo, and so on, it was about engineering a solution that works for this specific problem and that works well for this specific problem. And that's where I would say the creative element, the creative engineering element enters the solution.
That's a very fascinating point that you have just mentioned because you're saying that there is a particular solution to each and every single use case in relation to the use case itself. And for me it's where the critical thinking that we have spoken about previously actually comes into place because now we have like an idea, we have the SARS algorithm, we have the cube, we have like the temporal difference inside SARS that we can actually leverage as computing those like I don't know 10 different variations or hypothetical variations for understanding market impact empirically for each and every single occasions, and then doing the engineering in order to understand or to resolve and to resolve that like for the specific use case that you're actually referring to. That's a significant point. But I would like to shift the gears onto neural networks right now, because neural networks have some limitations. And again, I'm in front of your portfolio in one of my screens here, and there is a very interesting paper that you have released in the end of 2023, Transformers versus LSTMs for electronic trading, which is a thing that I was looking before the interview. It really captures my mind because, you know, they're both have like transformers obviously offer the attention mechanism and and different variations of attention mechanism, but LSTM actually can't remember what like the action or the thing that you have done previously actually store it in a perfect manner to leverage in in future decisions. Now, I would like to ask you, how would you see or how would you leverage neural networks nowadays into quantitative trading? Because I think you know um, even though the large firms, I don't really want to mention their names, but they move towards understanding how they can actually engineer neural networks properly for their decision making process. And I would like to ask you, what do you think about it? What is the capabilities and what are the limitations of neural networks from that paper, and what are like the thoughts that you have onwards and so on?
Yes, so there are several aspects to this question, and I would say that the first aspect is just the use of LLMs within the research process and within the research and development iteration. Right. So for that, you don't necessarily need to drill down into the details of neural networks. You can just leverage LLMs for example, hypothesis generation, for uh, code generation, for automation of different aspects of things. And you don't necessarily need to see them as what they are, neural network systems, but it's about how do you safely incorporate something like that into the research process, right? How do you not rely blindly on the output of these things? How do you perhaps iterate, have some sort of an actor critic type thing around the output that they produce? How do you stress test these things, right? So that's one aspect of things. It's kind of an organizational and kind of process management thing. The second aspect is if you look at neural networks specifically for econometrics, for understanding the long-term behavior of time series, then indeed there is a particular line of research that I have been pursuing with my colleagues, which is looking at combining certain features of uh, uh, the LSTMs with transformers and so on, because as you said, they have different advantages. Some of them have emphasized memory, others have emphasized the notion of attention. So, in this connection, I would say that at a lot of desks where I have worked, just introducing that as as the primary way of thinking can often be politically challenging because that's not how people currently think about the problem, right? So sometimes uh, either for practice,
As a way of thinking, like I, I would like to clarify here because you say that this is how people think. Um, in a way that like people actually leverage their thinking skills in comparison to LSTM. Is that what you're referring to?
I would say you join a classical trading desk, right? And a lot of people may not be thinking in terms of neural networks. It may be difficult to just say, "Hey guys, what you do currently is wrong. Let's just look at neural networks," right? So, what you may have to do just to gain credibility is to think closer to the domain, right? Because it's understandable that a lot of people who don't come from neural network background, they would be emphasizing the domain. Say, for example, you're looking specifically at energy futures here, and energy futures behave in a certain way. You don't necessarily want to disrupt that thinking. You may say, okay, well, let's look at this domain. Let's understand the detail of this domain. That's always very helpful as the initial step. This kind of exploratory analysis of a specific market is very, very helpful. So I wouldn't rush into automating the econometrics of it. I would say, okay, well, let's look at it. Let's try and understand how it works. What what common features can you find in this data? Is there, for example, an effect such as sort of a trend following effect? If not, why? When was it there historically? Has it disappeared? Have there been regime shifts? So, in many markets, such as commodity markets, you don't need to use neural networks to just see that there are clear regime shifts, for example, in 2019 and
The asset
2022.
itself is not very liquid.
Oh, the assets are liquid, but quite often you may have kind of
Yeah, but
radical
the
changes.
complexity of the participants in the market, I'm referring to liquidity in a way that you have so many participants and it's very, very hard to articulate what actually happens in the asset itself.
Even though the asset is very liquid, right? You can say, look, up until a certain point, the market exhibited a certain structure. How do I know that? Because it certain strategies were profitable in that market, right? Certain types of strategies were profitable in that market for a long time, where I can statistically significantly conclude that the market has a certain structure which is exploitable through a certain type of strategy. And then you would get regime shifts, right? And a lot of the understanding of the market, right, comes from these understanding these regime shifts, understanding why they happen, and understanding the economical and political influence on those regime shifts. So I wouldn't say, I mean, if you just focus on the problem as a neural network application problem, you would perhaps miss a lot of this stuff. Right. And if you are to be successful in a particular market, you do want to have a feel for why the market behaves a certain way. Now, when you go back to the neural net, and again, you may find some opposition from classical quant teams, from classical trading teams, to just abstracting this stuff away with neural networks. Because you need to understand at what time scale these regime shifts occur, how to approach them econometrically, and so on, right?
How do you actually detect those regime shifts? Because with neural networks, I think it's literally I would be very careful and very cautious with my words, but I would say that understanding those regime shifts actually makes like the problem itself much more hard to understand and hard to articulate
Well,
with neural
I
networks.
I would I have a much simpler approach to this, right? I mean, as a practitioner, what I do, I just look at what strategies work over different time periods, and
So you're
markets
actually
you find.
testing universe of assets,
I test a universe of strategy on those assets.
strategies
Yes,
on
yes,
those assets. Okay.
on those assets, uh, and uh, and I tend to reason about what strategies are profitable over what time intervals on these assets. And this usually I find this approach much more insightful than using all sorts of econometric techniques, detecting change points and so on for detecting structural breaks. Um, I already know, I mean, I don't know, like a few hundred strategies that I would normally be applying to these things. And I just see when they break and under what conditions, right? And so if something is crudely speaking a trend following market, and as we know a lot, the existence of CTAs underline the fact that something was a trend following market, then then we ask the question, why does the market stop being a CTA type market? For example, that's a very high level look at it. And people have written fairly detailed and fairly technical analysis of why, for example, certain CTA strategies break down. And then the questions are, do they break down completely? Do they hide somewhere? My impression is that they hide somewhere. And so they become a little bit more difficult to exploit, but they do not completely vanish. These market structural things. Um, this is a separate question, but it can inform the development of neural networks. But I mean, neural networks are not my first choice tool for approaching a lot of the markets, right? A lot of the classical econometric and economic analysis can tell you quite a lot more and is explainable, right? So it's easily explainable. So in my research program, when I look at a specific asset, I have a very foolproof, very explainable approach to understanding what's happening within this specific asset and how it behaves and so on and so forth before I start looking at neural networks. Neural networks is something that I do look at, and we have concluded that certain custom types of LSTMs and custom types of transformers outperform the stuff that is available off the shelf. That's going back to the neural networks question. And there is an entire direction in my research which I call deep econometrics, where I look at classical econometric algorithms and I say, okay, how does this work in the context that I call deep econometrics? For example, if we have arch type or Garch type models, we know that Engel got a Nobel Prize for Arch, right? So it's a widely used technique, but it has its problems. So how can we then apply deep econometrics, and how can we back out Arch, right? What kind of architectures allow you to back out Arch? What kind of architectures allow you to calibrate the parameters of Arch? So that's a separate direction of my research. Um, but yeah, I mean, when I look at markets, when I look at alpha in particular, I tend to go from classical econometrics, from classical um, financial sort of know-how sometimes towards neural networks, but not necessarily towards neural networks. I mean, there is, even with reinforcement learning, I think you mentioned the energy complexity. The most one of the best things you can do with reinforcement learning is move away from deep reinforcement learning and say bucket it into, just use some sort of a tabular approach first before start introducing the complexity of neural networks. And that tabular approach tends to work quite well and can at the very least research.
Yeah, I had a small smile when you said that you tend to avoid neural networks, and especially if we're speaking about again reinforcement learning, you tend to move away very long distance relationship with deep Q networks and all those methodologies because it's literally it's very impossible to do. Um, to use those tabular methodologies with chaotic markets again, because it's very problematic to go onto that path. And after understanding your hypothesis about reinforcement learning, and after understanding your background and understanding about neural networks and their and its applications over the financial markets, I would like to enter your brain for a moment. And I would like to ask you, how would you start, like from beginning to end, alpha research? How do you actually pick a an asset? And after picking an asset, what are the phenomenon that you're actually trying to detect in the asset? How do you think of the phenomenon? And after thinking of the phenomenon, how do you actually congregate all those phenomena? Or I'm like hypothetically saying that you have detected few phenomenons, if you have chosen a very not liquid or less participated asset, and after congregated those phenomenons all together, how would you actually construct an alpha, and how do you use classical machine learning that are able to articulate how do they actually work to a GM by the end of the day, and you say, okay, here is the alpha that I have just finished working on. It is very strong, and this is how,
Yeah.
and this
So
is why, of course.
there are several steps to this process. And the first step would be having a reliable backtesting environment, right? It's building sort of a toolkit that allows you to ask these questions on empirical data. Just having some sort of a framework in place that you trust. And it tends to be non-trivial. It's not a question of just having a Jupyter notebook. It's a solid environment that takes into account a number of different edge cases. And this is what a lot of people get wrong. Um, the second step would be about cleaning and transforming the data. So take futures, for example, right? Futures roll, and the jumps between the roll can easily derail your backtest, right? So they will dominate the backtest because if you don't adjust for these jumps properly, then you will get confusing results, right? And it's not just about the futures. It's with equities data. You have various things like corporate actions, with um, with foreign exchange. You have very structural things going on. You have fixings. You have different structural gaps in trading, and so on. This step is about cleaning, but also normalizing your data. Uh, and this is where a lot of people also get it wrong because, say, you didn't get rid of the.
How you can create a reliable backtesting environment that you actually can trust, and eventually, futures roll, and you cannot really anticipate, like, how do they mitigate, or how the price will be
Well,
fixed after the rolling contract.
you don't
And
you take that out of the back test. You pre-process the data in such a way that
and
unless
and you
you yes,
and you put the rolling periods outside of the backtest, and you're actually
this is part of the backtesting framework. It needs to be aware of all these things, right?
okay.
So your backtesting framework is actually a sophisticated piece of software that allows you to perform these transformations but it's very easy to come up with transformations that don't work for this specific setting. So, for example, do you back adjust or forward adjust? Do you adjust by absolute values or by ratios? So for some types of backtests, it doesn't make sense to do one or the other, right? So you really need to understand all of these transformations. How do they fit the specific backtesting procedure that you are setting up? How do you trust your backtesting framework? Usually, it takes many years of experience to know all these, to know about all these edge cases, and to be able to correctly implement corrections for these things. Here is another example, right? If you are doing high frequency trading, um, it's there are a lot of microstructure noise type events. There is the bid-ask bounce. There are other microstructure type of events where you will find a strategy which looks profitable on paper, but it's just bid-ask bounce or something like that, right? So um, correct for that as well. But so there's a bunch of these things, right? There is a bunch of so basically you need to transform the data so you mitigate the effects of all these things that I'm mentioning here. And there are many of these things for every asset class, right? So it's really well take for example take I don't know cryptocurrencies, right? Say if you're dealing with perpetuals, there is the interest rate effect, right? There would be the various rebates and so on, which are venue specific, which impact the profitability of the strategies, right? There are various if you don't take them into account, but there are various latencies as well, right? So it's very easy to find a profitable strategy, right? So for example, for a lot of commodities, you just, subtract the moving average and you end up with something that looks profitable if you don't, for example, pre-process the data and get rid of some of these microstructural effects. The second question then, okay, um, realistically, I get my signal. What's my execution lag? At what point can I actually act on this signal, right? What's this lag? And the backtester should allow you to take that into account, right? So, and does that lag vary from, at different times of day? What are my latencies, right? So if I'm doing some sort of network stuff, what latencies do I take into account in the backtest? Do the latencies spike at any points in time? Do the transaction costs spike? So there's a lot of this stuff that goes into the backtesting that needs to be taken care of, right? And this is why otherwise you will see on paper something that looks very, very good, but it's not exploitable. The other thing is market impact, right? So if you go into kind of a niche market in particular, if you go into something which is relatively low capacity, then you can quite easily be hit by the market impact with that you do not model until you actually start to trade. Or, some people perhaps model it incorrectly. They make assumptions about the shape of the market impact. And then you start trading and you see the P&L disappear due to the market impact. So there are all these aspects. And then how do
That
you
you
model
haven't
market impact?
considered in the environment itself.
Yeah, that you
Yeah,
need to,
that's a very significant piece of
it's
of
multiple.
backtesting environment. By the way, if look, no, I guess that majority of those of the listeners here are coming from they don't come from the large firms, and obviously I guess that the large firms have developed their own backtesting environments with the S at the end
Yes.
at the end of the word, obviously, which is a very obvious, a very obvious fact. And I guess that people don't really, or they tend to confuse themselves very likely with the environment that you're actually referring to, which is, and you have mentioned that it's very non-trivial to think of all those aspects because I'm listening here and I'm saying to myself, hey, this is a hell of a work here that needs to be done even
Yep.
before starting or thinking of the strategy itself. Like
Yep.
you need to think about the asset, you need to think about all of the down points, and you have to pre-process the data, and you have to do it in a very reliable manner, even if before you want to start your process. And for me, it gets very confusing here because I want to transfer a message here together with you, Paul, to the outer audience, and I would like to ask you, how does much you know relatively small firms that work with outsource tools, or like open source tools, outsourcing tools, everything that you can actually referring to. How do they can actually backtest their strategies reliably, and getting to deployment with confident that they have done it in a reliable environment, that they can actually you know articulate what actually happened.
Well, I would say that even if you use, for example, third-party code, and everyone uses third-party code, and that, I mean, you will not be rewriting like, I don't know, your NumPy and so on, or your SciPy in Python, for example. You will not be rewriting BLAS in C++. So everyone uses some amount of third-party code. But the key, I think, the key is treating your code as your as part of your trading IP. Right, it's not separate. Whether it's your own code or you're using third-party frameworks, you need to understand exactly how it works, and to a large extent, right? So, if I, if I tell people, look, I mean, there is a trend following strategy which involves two moving averages, right? I can put it in one sentence, right? So, in a sense, the core idea of a trading strategy is usually a very short sentence, right? It's straightforward, right? Um, or I can say, look, you can use such and such a data source which will provide leading information. But the tricks that I'm talking about, there are many of them, and collectively they're non-trivial, and that is the bulk of your IP as a trader, right? It's not really this moving average thing, right? I mean, it's also part of your IP, but
Yeah.
to a large extent, it's all the stuff that I've mentioned here, which makes you a professional trader. And it's kind of treating it systematic, because many people will end up kind of rediscovering a lot of these things. How do they rediscover? They come up with a backtest in a deficient framework that looks profitable. They go live with it, perhaps in small size, and then they notice that over the days and weeks, a month, that the profile of the strategy P&L does not match what they have in backtest, right? And then they panic, and then they start perhaps reverse engineering these things and trying to say, well, why does my backtest look completely different to what I'm observing in production, and so on. But that may be happening at a time scale which is, you can lose money basically by doing that. You would be paying for this with money as opposed to with learning, right? So a lot of people end up discovering this the hard way, but also what does tend to happen if they work with experienced people on desks, then a lot of these mistakes will get corrected before they are introduced.
Yeah.
So, if you have a proper process like code reviews, right? So someone experienced reviews the code that goes into production. Um, uh, Diligent comparison of what goes on in production versus research, right? Because you can easily test, okay, here is the distribution of the P&L that I'm expecting based on my backtest. Here is the distribution of the P&L that I'm getting when I run it live, right? Even if you don't have enough observations yet, you can still plot the two histograms. You can compare the difference between the histograms. You can say, look, is there something structural going on between this and this? P&L attribution, right? Implementing P&L attribution in production, and safeties and controls around the stuff that goes into production, right? You don't want to have, the type of disaster that people had at Night Capital, right? So you want to have a really stringent environment from the software engineering point of view, but also you want to have something where you can ask these statistical questions, right, at any point in time. So the successful players, they tend to have very carefully monitored and very carefully engineered production environments where they can immediately look at the distribution of the P&L. They can look at all the stats of everything that is going live. But of course, at certain time frames, right, at certain time frames, the P&L distribution, will. I mean, if you're not doing some sort of a very high sharp type arbitrage strategy, if you're doing some sort of daily trading type stuff, then then the distribution of the P&L will take many days to emerge, right? So it's how do you really come to these conclusions with limited data? So there are a large number of these concerns, some of them statistical, some of them software engineering, that you need to take into account.
You know, um, I would like to start with the beginning of your answer, and you said that the reliance of third-party code might be tricky. And when I do my research, I focus on not doing or not relying heavily on third party
Yep.
because third party might be good, but in order to have a reliable piece of code that eventually, code reviews, uh, 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 the code reviews will pass the code that you write will be actually a thing that you have built in order to tackle that specific use case. And I would like to ask you, how do you think that reliance of external Python libraries when you do research actually corresponds to like the third party itself, because I sometimes do like the entire linear algebra calculation inside of the code. I don't have like any reliance on everything. And I would like to ask you, how do you actually structure the research itself? Again, I'm referring back to the first question I was asking, not just about the third party, but I was referring like on the research topic itself, like the asset, and how do you actually tackle the asset after speaking about backtesting environment and understanding all the fluctuations in the asset types. How do you actually create a reliable environment, and understanding how to create a proper research based on those based on that surface level.
Yeah, so I would say that uh, the in terms of the reliance on third-party software, it's a matter of prioritization. I think you really need to understand the core of the algorithms that you're applying, right? Need to have intuition for those
Very
algorithms.
challenging.
Yes, yes, but I mean, say you are doing something like a Kalman filter, right? A straightforward Kalman filter. Even there, right, there are various tricks that are not immediately, or various concerns that are not immediately apparent from the mathematical form of the filter. So you would, for example, well, I mean, the ratio between the covariance matrices, how does it impact things, and how do I estimate these covariance matrices? So you really want to implement it at least once yourself, right? You really want to have, perhaps it may not go into production. You may take something off the shelf, but I would say that yes, so you would implement it, run on data, and you would really look at the innovation sequences. You would really produce some plots and understand what's going on there, right? So that's so, and but then something like Schmidt, for example, I wouldn't go into Gram Schmidt necessarily unless I have to debug something, right? Something like your uh, various orthogonalization procedures. I would probably not go into them, but I would check that I mistake somewhere at the level of the library, for example, that I'm not by accident transposing the weights or doing something like that, which the library may do in a non-standard way. But
Uh-huh.
for example, you know the SciP PCA implementation, right? So the weights may be, if I remember correctly, the weights are transposed in comparison with what you would consider standard PCA and so on. Um, and that applies to many different algorithms. Is do you really understand the inputs, the outputs, how they are structured, how they appear in this specific library? But it's a matter of so you're programming under constraints, you're programming under budget constraints, you're programming under time constraints. So the question becomes, how do you optimally spend your time, given that it's constrained, right? So um, you probably don't have the time to write all to write your code, to an entirely independent code base. And then it becomes an engineering choice. Given I have this much time, right? Given that I have this much budget, what am I going to focus on to come up with a minimal viable product, right? So it's kind of and you sort of tend to view this as a from the software management perspective, you tend to view this as a sequence of minimal viable products, right? So
So
you're saying, look, I mean,
you're actually aiming to capture those low hanging fruits. Obviously, I'm doing that like other
yes,
organization, but you're actually aiming to aiming to capture those low hanging fruit in order to accelerate the process itself. So when you're actually trying, I'll just reframe everything that you have said in a very quick sentence. After you have done your research, or in during the research itself you're trying to understand how it will work, like the abstract idea. You're actually trying to create that abstract idea, and after understanding how the abstract idea will work, then you derive further conclusions to build on top of it.
I like to think in terms of low hand because in practice, that's all you basically end up implementing, right?
Uh,
So in practice, because of the time pressures, you are always forced to take, to go for low hanging fruit. Question then is, if you understand the strategic direction of your research, how can you start reaching for the fruit, which is still, which is strategically important, right? But you may have to satisfy, you know,
that's a very struggling that's a very struggling challenge as well. How do you
it's very difficult.
understand the rightest fruit?
I mean, the systems, right? The systems, whether they be financial or academic, are not designed for kind of strategic thinking, right? The system is incentivizing reaching for the next low-hanging fruit, right? Because you are always under pressure from either management or investors or academic committees or investment
You're
committees, and
under
so
pressure.
you're always under pressure. Okay, so you're
Yeah.
always under time pressure. So it's not it's not like, yeah, I mean, I'm just going to come up with an optimal solution. I have an unlimited amount of time, right, and I have an unlimited amount of resources. So then I'm gonna, so that doesn't tend to happen. So then you have to, first of all, there is an important kind of aspect to it, which is kind of managing expectations and carving out the space for you to implement stuff, right, despite these pressures. So, how do you push back on investors without, for example, without causing them to take the money out of the company, right? So, how do you say, look, I mean, we need to do this, and then you probably wouldn't do this initially because you would need to build some trust, you would need to produce some results. So I remember when I joined one of the big banks basically, and I was writing a trading system for a specific asset class, and I was sitting with voice traders that, look, I mean, this is not possible. You cannot really electronize it. I said, well, I've done this before, and they said, well, you have 1 month to do it in, right? Otherwise, we don't believe you. And I had to literally code
Gosh.
nonstop for a month to have a minimal viable solution to show them, look, guys, yes, this solution works. And
It
then
worked. It worked
it did
eventually.
work. It did work, but
Oh, congratulations.
that then bought me another half a year, right, of kind of reduced scrutiny. So I mean, I shipped that, right. I showed them that that thing worked, but that bought me the trust that I needed the next iteration of the system, right. So I didn't build initially what I wanted to build, right. I built something that was a mini product, but that earned me the trust that then I had more time to build the next iteration of it the way I wanted to build it.
Yeah. Yeah, it's fascinating. It is very fascinating. And now I would like to speak about machine learning. You know that that saying that I wanted to talk about machine learning is very very rough and very very ambitious to say. But I would like to speak about machine learning in a matter of trading applications. Um, I would like to brainstorm together with you how it's like choosing the rightest ML algorithm, and after choosing the rightest ML algorithm for your specific use case, how do you actually engineer it properly? Because when I work with machine learning, I use a lot the CPCV methodology, which I think makes sense of the reason that I use it, and I try to estimate the strength of the signal, and doing like the main model and meta model and like different variations of architectures and utilizations of machine learning that are not very understandable or very well spoken nowadays. That I would like to brainstorm together with you. And what do you think about all those methodologies and different architectures like doing meta model to understand the strength of the signal and model to I don't know to parameterize the parameters that you actually give to the model itself in order to make the strategy much more dynamic, and so on and so forth. We can have like an entire discussion just over that, but I would like to hear your standpoint and how do you actually choose your right machine learning algorithm, and what is the process that you're actually proposing in a sense of choosing the rightest algorithm.
Yeah, so I would
So, sorry for the long question, by the way. But it was necessary in a sense.
no. So So a lot of the practical aspects like meta labeling and so on, and I mean, are you can find them in DiPrado's books and posts and blogs and so on. For example, uh, my approach is okay. My approach is first of all to establish a baseline, right? So I find the simplest possible model. What's the baseline? What's the most basic thing I can do, and does it work? Does it give me any predictive value? Does it give me anything? Right. So I would probably start with some form of linear regression or something like that baseline. So I would always, when I'm building this stuff, I would always do it as a sequence of models, right, from the simplest to the sophisticated, right? And so you come up with the baseline, right? You look at the outputs. Does it actually did it do anything useful? Does it have any predictive value? And then if it didn't, then what's the metric that tells you where in your parameter space or in your search space, in your data space, where does it fail and for what reason, right? And can you quantify this? Right? So you would say, okay, say this is linear regression. I mean, this is a classic case, right? Say this is linear regression, but your model is nonlinear, right? So if you collapse it to
Most times the model is not linear.
yes, but exactly. So if you collapse it to two-dimensional, so say your space is high dimensional, right?
I'm
It's
going with
difficult
you, of course.
difficult to reason about, right? But what you do, you end up with these plots of like just split your space into these two variables, and look at the scatter plots, right? Do they look nonlinear, right? What do they look like in comparison with the slices of the hyperplane, right? So then you already say, okay, well, it's nonlinearity, right? So it's nonlinearity, and then you can start reasoning about, but is the nonlinearity enough to make it useless, right? I mean, is that the main thing, right? So that's then okay. So you kind of sequence your models, but you really need to sort of start. You really need to see. You really need to see graphically, or in terms of metrics, usually both metrics and
How
graphs.
important it is to see graphically
How
the
do you?
results
Well,
that you're
I mean,
actually.
again, so if you have a scatter plot, right, but your cloud looks like this, right, for example, or like this, or something, something that doesn't
Yeah,
allow
any different combination or
anything,
variation. Yeah,
anything that doesn't align with a Gaussian envelope around the 45-degree line, right? That tells you that there is something nonlinear going on. But then you can ask the question, okay, is it nonlinearity or is it because the model it changes behavior over time? So then you produce an animation and you see how these graphs migrate over time. Okay, so then you quantify these things. So you say like, look, this is how nonlinear it is, right? This is the basically here is the QQ plot, right, or something like that. Um, and then you start saying, okay, if this is if the issue is with linearity, what's my next step, right? Well, my next step will probably be to use a random forest or something like that. But ultimately, it needs to be a process which is guided by metrics and observations, right? Because otherwise, people start fetishizing these models,
by
right?
metrics and observations.
That's right. That's right.
Okay. And how do you set up the metrics and how do you observe
Um,
properly?
well, this is really to a large extent this is part of the art is really understanding.
You're
Um,
the artist here.
well, it's
Yeah.
what's the most insightful metric, right? I mean, this is where lots of people start looking at sharp ratios, which may not be immediately applicable in, say, market making and so on. Uh, it's it's okay. Okay, what are the met? What, I mean, what are you optimizing, right? What's the thing that you're optimizing? Is it profitability? Is it risk? Is it some sort of risk adjusted profitability, right? And then you end up with some sort of sharp like loop, right? So then, and then so usually the closer the metric is to the thing that you're actually optimizing as a business objective, the better, right? So you probably don't want to have a very abstract metric. But then if you start saying, look, it's actually linearity, then you start moving away from that metric. You start introducing a metric which expresses the problem, right? Which would be some measure of linearity, and there are many of them, right? And then then only then do you complicate the model. Do complexity, and then you say, okay, well, does this work? Does it work well enough for me? Does it solve my business? Not how can I again visualize it, and how can I describe it in metrics, right? So then you have the sequence, right, of things that you are achieving.
You
I mean, you can
anticipate.
yes, and you iterate, and maybe
You
you
iterate over those metrics in order to locate the rightest algorithm for your own use case.
yeah, yeah. It may be a systemic
Okay.
thing. It may be something where you say, look, I mean, I cannot compute these metrics because I don't have enough observation points, right? And this is where you end up with things like cross-validation and so on. You start saying, can I be more sample efficient, right? But ultimately, it's a sequence of steps which should be dictated specifically by the results, by the observations, and that's ultimately applying the scientific method.
Yeah, no, it's a very interesting hypothesis that you're actually proposing here. Choosing between like having metrics and observations in order to find the rightest algorithm, which is slightly different than what I was talking with the other ones in the show here. And I would like to ask you, out of your perspective, what is the model or the type of the model? It could be gradient boosting, could be uh, even linear regression, which I think will never be the answer. But what is like the go-to model that you're actually going for? Because speaking about the low-hanging fruits, you need to understand. You said that it is an art, and it is not a scientific approach, but it is an art to understand what you're actually looking or intending to look for.
Yep.
Um, and my question is basically, how do you actually look for the rightest collision or even cluster of algorithms, and you actually testing that specific cluster?
Yep.
Because building metrics and observations all around the algorithms will be a never-ending problem. It could be so
Yep.
how do you actually filterize your the process, and how do you actually think of it like as a perspective of an art, not and not just like as a perspective of doing scientific processes?
Well, the first thing I would say is that if your search space is large, right, you don't have the choice but to go to right. So and it's the quality of the heuristics that determines the efficiency of your search, right? Ultimately, this is the this is true for all of machine learning. So different models, different. You can think of them as different heuristics that guide your search in a very large space, and they are all ultimately ways of dealing with the curse of dimensionality. But the bulk of my methods are not my first go-to algorithms would not be machine learning algorithms, would not be the stuff that is published, right? My go-to methods would be understanding. the market. For example, understanding microstructural events, right? Knowing where events occur. Things like roles and fixings and things like that,
Yeah,
and
so you
perhaps
build
an
your
out.
observations.
And then I would kind of understanding this stuff. I actually then build a lot of tests around them and say like, look, do these events lead to predictable structure? So this is closer to what classical people do for or like a classical arbitrage. Are there two or three related products with exploitable relationships, right? I mean, if I have an exploitable relationship, I don't need to do much machine learning. I have something that is structurally there. Anything you do on the basis of machine learning in finance is going to be around statistical arbitrage, right? I mean, if you
Yeah.
can find a structural arbitrage that, rather than statistical arbitrage, that immediately, if this arbitrage is relatively persistent, you would go for that, right? And then then types of other things, right? And it's supply and demand relationships, for instance, right? Do I understand, for example, what drives oil and gas prices, right? And can I express this in terms of supply and demand relationships? Can I kind of come up with something that tells me why these things move in certain direction? Even with things like, tweets, right? So, for example, so there is a tweet from a politician and it influences things. Can I somehow quantify this? And can I quantify it in terms of a kind of a model? But then that's the first generation of things. Like it's really understanding the asset class, commodities, FX, crypto, credit, rates, equities, right? These are the things that I've been looking at. And do I understand the structural things that tend to exist in these markets, right? Also, if it's trend following some of the time, then what's the conditional variable, right? When does trend following work? When it doesn't work? What is it that I can condition on, right? But that's already increasing the complexity of the model. It's like what can I condition on to actually back out a profitable strategy, right? If people say, and a lot of this you learn by, I don't know, by drinking beer with traders, right? So you kind of go out to a pub and just listen, have some conversation. And some say, oh, you know what? This is an inflation driven market, right? And someone say, oh, interesting. What do you mean by that? Right. So that's kind of old school trading, right? And I learned a lot of ideas by doing that, right? And then I
Mhm.
say, okay, well, how can I quantify it? How can I test what this guy just said about this being an inflation-driven market? How can I test it? What are the tests I'm going to run, and how can I test the stability of this and so on? But then the next category of algorithms would be okay, what does work in time series, right? And here I would say indeed that things like boosting is kind of a useful category, but a lot of stuff here again depends on how do you select your features, right? What are the features? What are the things that go into?
Features has to be like the set of features that you're choosing have to be orthogonal.
No,
And
not at all. No, I mean
no,
you can orthogonalize them later, right? You can orthogonalize them later. I mean, you can orthogonalize your features. I mean, when you brainstorm the features, you just and if they and it depends on what it does depend on. It depends on the frequency of your trading, right? Because say if you're doing high frequency trading, you will look at kind of market microstructure, balance type stuff, right? Which may not be scalable enough to work intraday, right? So it may work but may not scale to intraday time scale. But then what kind of things do you have for intraday stuff? There is a bunch of things, right? Um, I mean, and then again, so there is a set of these features, perhaps thousands, tens of thousands of features but this is where you start saying, oh, I have too many features. How do I just select the ones that, without overfitting? How do I select the features and
and
so
then
on?
you discover the curse.
And then you discover the curse of
Then you
dimensionality, then
discover
you
the
discover all
curse.
the problems that lead to, but there is a lot of stuff written on feature selection which is good. Like I've written some stuff on feature selection as well. I've been trying to understand them. But then yeah, I mean boosting and similar type of algorithms tend to be really good. Neural networks, yes, but again, like like apply them in what context, right? And that's, I think those are, I mean, you have seen some of the studies that I've done in neural network architecture. I mean, and I've tried to understand it at a more fundamental level. So what is it in the architecture of the neural network that makes it effective for this specific use, for this specific type of parameter, because there are different parameter types and so on.
You know, um, that was a very stunning point because I really think that what you have just said, especially when speaking about machine learning, actually enforces people to think about the underlying um, occasions and the underlying clarifications that we have to do in order to understand how to build a model that will do some very consistent and profitable results, and it will yield profitability to the GM by the end of the day. Now, I would like to ask the last question for today's conversation because I very like to have a very uh, uh, very human question in between the two of us. Um, and my question is for you, Paul, is I would like to understand where and how do you envision yourself in the next couple of years? How do you see yourself, uh, um, you know, coming along with the quantitative finance industry? How would you see the fluctuations business wise, and how do you actually think that the trend following strategy for that specific industry will actually be in 10 or 2 or 3 years from now?
Yeah, so I would say that the rate at which things develop nowadays, both technologically but also geopolitically and so on, socially, so high and it's so difficult to predict. Is that I think
Short
this whole thing.
periods tends to be a decade nowadays.
Yes, yes, exactly. But I mean, what I would really say is I'm try. I mean, the reason when the environment is unstable or rapidly changing, right? What I try to do, I try to sort of focus on kind of robustifying the methodology. It's more like, okay, so there are these things that I've been doing over the years, and I know they work, right? So I stick with those things, right? So it's more like, how do I create um, for, an organization that functions within this changing ecosystem? How do I make sure that the organization remains productive, but also how do I make sure that remains relevant? So sometimes it's about, for example, abstracting away from the latest changes. So for like today, reinforcement learning is popular, right? Tomorrow it's LLMs, right? So sometimes it interests you to say, I'm an LLM guy, I'm like a reinforcement learning guy, or I'm this and that, right? And there is, from a certain point of view, there's advantage to that because you are marketable, right? Because people say, oh, I know what it means to be an RL guy, I know what it means to be an LLM guy. But at the same time, it makes you a little bit more fragile because what happens is maybe a year down the line, there will be a new thing and people will not be as interested in what you're doing anymore, right? So perhaps so what I try to do, I try to abstract away from that and say, like, look, I'm a computational scientist, right? I'm a quantitative scientist that uses a set of techniques to solve problems, right? So I tend to sort of abstract away. I don't want my beta to a specific technique to be too high, right? But at the same time, I don't want that beta to be too
That's
low because
nice.
yes,
That's nice. That's a very nice sentence. I like that. Okay.
you want that beta to be somewhere like reasonably high but not too high, because then you don't want to go under with a technique, right? But at the same time you want to be kind of reasonably robust. So you have to, like, if you think of yourself as a some sort of a perhaps non-linear regression or something like that, you would have a number of these betas, right? But then you don't want them to be one, right? You don't want them to be zero, you don't want them to be one, right? So it's really that. It's like it's really I tend to focus more on the okay, what's the discipline of being a good quantitative scientist, right? What does it involve? What's the discipline? How can I be productive across multiple regimes? Right now, that's what I normally advise people to do. Is how do you, you know, look at like when I was trading CDSs at some point in my career, and then Deutsche Bank, where I was, exited CDSs completely. Okay, so if I marketed myself as a CDS person, right, then I would be in trouble, right? And this is where you probably want to sort of to have a level of abstraction, and perhaps anti-fragility. I mean, I know this is kind of people overuse these terms, right? But I mean, I would tend to, yeah, perhaps so some sort of decoupling from specific techniques, but reliance on specific processes and methodologies, right? And being good at those processes and methodologies. This is not just at the level of branding, it's also the level of software. Like, how do I build software frameworks where I can plug and play different algorithms, different asset classes without making too many changes, right? While carrying a certain amount of IP and a certain amount of perhaps just practical knowledge with the framework without dissipating that knowledge. I mean, I would say that that's one of the most important things in this process. That's what I would do.
I have two words to say about that conversation, and that's phenomenal conversation. I think that like the we have scored so many like different variations of topics here, but they all correlate to each other in a perfect sense. And it was a very me and you we tried to arrange that conversation. I think for a very long time now, and I think it was very much worth it because I have enjoyed it so much, and I would like to thank you for your participation. And obviously, as a host of a podcast, I instantly know and I develop that intuition of what type of episodes people will like and what type of episodes people will say, okay, it's fine, but I would be able to derive much more value out of that specific conversation. And I think that the conversation that we had now was one of the conversations that will eventually lead the season in terms of you know congregation of audience and people that will actually be able to derive concrete information to enhance and to push their career onwards, and hopefully they will be in the middle, and their beta will be high, but not very but not higher as you actually propose, because that's how people are supposed to behave, either in business or in real life, like as persons. And I really really appreciate that opportunity, Paul. It was
Likewise.
my pleasure, and yeah, thank you for your participation.
Thank you very much for this opportunity. I hope you've enjoyed the discussion. Thank you very much.
I have
I did.
enjoyed it very much. Okay, so till the next time, guys. See you on the next episode. Many thank you, Paul, and bye. Bye,
Bye bye.
everybody.
Thank you very much.